Hi everyone, my name is Marcy Bergen. I'm the Member Services Coordinator at ASTA. Welcome to Align Your Auto Lending Strategy for today's Trends and Tailwinds presented by Jonathan Smokes and Isabelle Helms. This presentation is a part of ASTA's Business Partner Webinar Series, which allows industry experts to share timely educational topics with ASTA members. For more information about this series or how to become a presenter, feel free to reach out to me following today's webinar. A few housekeeping notes. To ask a question, use the question box on the side of your screen. The slides and recording of today's webinar will be available later today in ASTA's website on the Webinar Resource Center. Finally, you'll receive a survey after the webinar is over. Please take a moment to complete it. Your responses help us fine-tune the program so we can target the issues that are important to you. A bit about our presenters. Jonathan Smokes serves as Vice President and Chief Economist leading Cox Automotive's Economic Industry Insights team, which leverages data to expand Cox Automotive's deep expertise in all aspects of the automotive industry. The Industry Insights team tracks new and used vehicle sales, supplies, prices, retail, and fleet demand, consumer credit and auto financing, and dealer sentiment to understand the trends in impacting both the wholesale and retail markets for vehicle informed by all the data of the company's businesses and platforms, including Manheim, Auto Trader, Kelley Blue Book, and DealerChat. Smoke holds a bachelor's degree in economics and religious studies from Rhodes College and a master's degree in business from the University of Texas at Austin. Our other presenter, Isabelle Helms, leads the research and market intelligence team at Cox Automotive. In her position, Helms spearheads the efforts to provide primary research, competitive intelligence, and market insights to inform decision-making across Cox Automotive, and its various brands. Helms' team works diligently to uncover, understand, and deliver the voice of consumers, dealers, lenders, fleets, and other Cox Automotive clients and prospects, while also keeping a pulse on the market trends impacting the automotive industry. And now I'll turn it over to you, Jonathan and Isabelle. Thank you.
All right, thank you, Marcy, and thanks for having us back. I'll be going through the economic outlook, and I can assure you this is not going to be a negative economics presentation, because the outlook is very optimistic and getting increasingly more so. At the end of last year, we had a wide range of uncertainty regarding the path of what COVID would do and the composition of the US government that would influence policy response in 2021. Both have now resulted in stronger growth expectations for this year. We now have expectations of growth for the year of 6.4%, and I wouldn't be surprised if it ends up being close to 7%. GDP, in fact, will be fully recovered before we get to the summer. The unemployment picture is complicated, but the bottom line is that recovery has been very strong and it is accelerating. March saw over 900,000 jobs created, and job growth is accelerating, reinforced by today's jobless claims numbers. While we still have a large number of people on some form of unemployment benefit, those people are currently fully supported and will be supported at least through September because of the American Rescue Plan. The average unemployed hourly service worker right now is actually making more money than when they were working. And given the government spending and support in place, as well as assumptions that we're making on COVID, the unemployment rate is expected to improve throughout this year, likely falling to under 4.5% in the fourth quarter. This is very good for vehicle demand. A low and declining unemployment rate is the perfect environment for the strongest demand possible. And then when we look at consumer sentiment, the story continues to improve there as well. This is the index of consumer sentiment from Morning Consult, which is a daily reading we can track. It increased a full percentage point in the last week. The index is now up 12.7% from where it was at the end of January. And it's now down by only 11% now compared to where we were at the end of February 2020. So in other words, we've gained more in 2 months than what the remaining gap is. So we could see consumer sentiment fully recovered by the time we get to the summer too. And this, of course, is very supportive of car buying. So let's take a look at the financial condition of consumers. And there it's a more complicated story. We've had unprecedented levels of stimulus, but last year that support wasn't very consistent throughout the year because most of it was in March and April, and then elements of that support expired as the year progressed. And so we saw that reflected actually in the second half of last year with sequential negative months of income change. But we ended the year with a $900 billion stimulus package pass. Then in March, we had the American Rescue Plan, which was $1.9 trillion. So just the December passage reflected a 10% increase in income in January and a corresponding increase of 3% in spending. February was a bit of a head fake because, of course, yes, we had less of those cash payments, and that's why the income number came down relative to January. But on the spending side, we also had that severe winter weather that disrupted spending all across the country. So I would say ignore February, because I can guarantee when we get the March numbers, which won't happen until the end of this month, and then the April numbers, they are going to reflect even larger increases in both income and spending. And today's retail sales numbers absolutely back that up. And the vehicle sales numbers I'm about to share with you too back that up entirely. But also with the income and less spending that we were doing, we've saved quite a bit of money. The next slide shows you what the accumulated amount of money in bank accounts across the country look like. And this is as of March 17th. Total deposits are now up $3.4 trillion that didn't exist a year ago. Some of that is stimulus that went directly into savings, but others reflect simply the lack of spending. So net savings growing, especially by higher income groups. Well, this amount alone represents about 15% of GDP that could have powered a really strong year by itself once consumers felt more confident about the future. But of course, that's not the only source of cash and available spending that we have. So financial condition looks good. And as I mentioned, it'll be supported even with those who are lower incomes. But what about the credit picture? And the credit picture has been changing. And last year was definitely not a year that was favorable for all parts of the credit spectrum. Because last year, automotive loan originations in dollars actually increased by 0.6%. But all of that increase was driven by the highest two credit tiers. So from a 720 FICO score and higher. By stark contrast, subprime declined by almost 10% in 2019 on a year-over-year basis. So it reflected that last year was not a year that all types of consumers were willing or able to buy. And that is another thing that is starting to change this year. And one of the reasons for that was the incredible loan performance that you all saw last year. So if we look at what we've actually observed in the auto loan performance, it tells a story that's also very supportive. And by the way, to AFSA, I applaud the blog post that you did last week to correct some of the misinformation or poor analysis that I think was reflected in the Wall Street Journal last week. So what did we see happening last year? Well, last year, consumers used stimulus and savings to pay down debts of all types. And consumers also benefited from loan forbearances and accommodations that led to a declining delinquency rate in every sector, but here I'm showing just auto loans. The rate declined on auto loans every month through August last year. That happened to be exactly when some of the CARES Act benefits started to expire, namely at the end of July, the enhanced unemployment benefits expired. June was the peak of auto loan accommodations at 8%, as estimated by Equifax. And accommodations have been coming down. We currently see them at about 2.3% as of the end of February and again at the end of March. But at the same time, the support of consumers was weakening at the end of last year, hence a rising but still down compared to the prior year severe delinquency rate. But all of that started to move in a positive direction again. Lo and behold, guess when? In February, when the cash payments from January and the extended and enhanced unemployment benefits started to kick into place. And we just received the March data this week, which is reflected here. And again, we saw severe delinquencies decline and the severe delinquency rate decline again. So overall, loan performance has been stellar. And when you combine that with the improving economic conditions, declining unemployment, high vehicle values, lenders are now getting more willing to lend to a broader spectrum of consumers. And that's especially true, I believe, in subprime. And I'll show you the data to back that up. The next slide shows you what we're seeing in auto loan rates. And it's really not last year that I want to pay attention to, it's what's happened in the last 2 months. Last year, we saw a clear difference between what consumers are receiving in types of loans. So for example, mortgage rates fell more than auto rates on average last year. And within auto, there was a huge difference between what the highest credit tier was seeing versus what subprime was seeing. So last year was only a great year to buy with credit if you had good credit. But this year, the story is interestingly going against what the headlines in the Wall Street Journal are reflecting with what's going on with bond yields and even with mortgage rates. This year, we're actually seeing bigger declines in subprime rates, and indeed the average auto loan rate came down as well in March. But for subprime, it's come down substantially, almost the best level of rates in 2 years. And subprime currently represents 16% of consumers. So we just opened up a portion of the market that was not very active in the strength last year, and it helps you to understand why March was so strong. And I'll show you just how strong that was in a second. But another piece of data to back that up is our credit indices, the Dealertrack Auto Credit Availability Indices that we started publishing in December. And if you haven't seen them before, we're basically taking data on every auto loan that comes through the Dealertrack platform, and we look at the approval rate, the subprime share, the yield spreads, and the terms on those loans to basically judge over time, are these conditions looking like credit is tighter or credit is looser? Well, last year, it was definitely tighter, with the exception of the very beginning of the pandemic when captives were particularly aggressive to get the new vehicle market kick-started, especially back in April. But as the year progressed in the summer and the fall, we really saw that tightening reach the tightest level. But then as the fall started to turn things around with strong vehicle values and strong loan performance, we actually saw loosening to end the year. January saw a bit of tightening, but then loosening began in a substantial way, both in February and in March. And so the data tell us right now that it's a wee bit harder to get a loan than it was pre-pandemic, but it's improving, and it's especially improving for subprime. And our estimate of the subprime share on Dealertrack across all auto loan types rose to 16.1% of all new auto loans in March, compared to a low of 12.6% in December. So we've really seen that start to turn around, and that helps to explain what we're showing on the next slide, the vehicle sales recovery. Retail sales were up strongly in March. For what I believe, if you had perfect data going back 30 years, March was probably the strongest month so far in the history of retail vehicle sales in the United States. We estimate the retail new vehicle SAAR in March was 15.4 million. And that is indeed a record in our data that we can calculate going at least back to the Great Recession. And then the retail used SAAR of 22.2 million was the best March in history, but it was bested by 2 months last year, June and July, which happened to be the 2 months last year that used vehicle sales were higher than 2019. So what we saw was actually a March that wasn't just better than 2020, it was better than 2019, which was a very good year. And so how has April started? Well, April has started even hotter. Our initial estimates for last week measured new sales up 18% compared to 2019, and used sales were up 22% compared to 2019. It is indeed shaping up to be an incredible spring. And my favorite slide is actually the next one, because here we're taking the unique credit applications on Dealertrack and we're comparing them to the same week in 2019 for the week ending April 4th this year. The last year is the week ending April 5th. What a tale of two different markets just in 1 year's time. Last year, the map had a lot of deep red, and those darkest red spots in the map were down 95% year over year compared to 2019. And you have to really squint to see the 7 flecks of green, the only markets in the country that looked unaffected by the pandemic lockdowns that week in 2020. Now compare that to the beautiful map on the right, where we have no red whatsoever. We only have 34 spots of yellow, and those spots of yellow were down only about 20% compared to the yellow last year was down on average by 50%. And we had 172 green markets that week average being up 10% compared to 2019. I believe these maps scream that spring sprung at the end of March and is persisting into April, and it indeed reflects a retail market that has recovered, and in fact has recovered virtually everywhere. So is there a downside to all of this? Well, in the marketplace, yes, there's one clear answer to that. It's supply. New and used inventory levels are down substantially year over year, and they're aggressively moving lower with these strong sales increases. We estimate the new inventory at the end of March was down 32%, and used inventory was down 15%. And you can see from the lines that it's actually getting tighter. And another effect of this is we're seeing declining incentives. With supply tight and getting tighter, incentives have fallen and they're going lower. We did have a minor uptick in what I'm showing here, which is incentives as a percentage of the average transaction price. But that was because prices declined a bit in March because the mix of vehicles shifted to more lower priced vehicles, which is consistent with more subprime buyers being more active in the marketplace. It's not because they're getting more discounts. It's simply because we're seeing a mix that's really reflective of a more normal market compared to what we had a year ago. So the story is clearly strong, but it's not necessarily true when you think of it from a supply and from a pricing perspective. So let's look at what the Manheim Index did in March. We had an astounding 6% increase, bringing the Manheim Index to a new record for the second month in a row. But I can tell you this is not the end of these records. We project that we will have a record in April, May, and June. So that's the side effect of this strong spring. And what do these strong values do to residuals? We'll take a look at the next chart because it shows the retention value calculations that we do with Kelley Blue Book. And this is year to date, looking at 1 to 3 year old models compared to their MSRPs and what they look like in the last 2 years. The green line for this year is clearly jumping, just like the Manheim Index. Higher values have translated into what I would dare say anyone on this call would agree is previously unthinkable retention values that are technically up 12 full percentage points compared to last year and more than 13 full percentage points compared to 2019. And as I just mentioned, we haven't seen the peak yet. That helps to explain why lenders feel a bit more comfortable about lending in this environment. And we're not done yet. Wholesale prices increased 1.6% last week, while retail prices increased 0.9%. If you're worried about that gap, don't worry. It's because dealers principally price their retail based on what it costs them to acquire the units. So if we actually lag the retail prices with the wholesale prices by 6 weeks, we actually see those numbers are tracking very closely aligned. So dealers are managing this, are adjusting their pricing, and we're going to see retail pricing continue to go up even longer than we see these wholesale prices. So I'm going to end with just a recap of our forecasts. I know many of you follow them, and it's tough to keep up with them these days because we keep having to upgrade them. We have upgraded our new vehicle sales forecast to now 16.1 million. We would sell even more if we weren't so supply constrained. Used retail at 21.5 million will be a new record for used retail, at least going back to the Great Recession. And probably likewise, if we had more vehicles, we would see an even higher number. And then the Manheim Used Vehicle Value Index forecast has been upgraded to a 20% average year-over-year increase for the year. That's comparing every single month's year-over-year average for the year, you get to 20. Obviously, within the year, we're going to have a huge roller coaster because April is going to be not the absolute peak, but certainly building upon what I showed you already compared to the lows last year. So don't be surprised if in early May you hear us report that the Manheim Index is up somewhere between 47 and 50% compared to 2020, because that's what is likely to happen. By the end of the year, we're expecting a bit more normalization, and what I mean by that is more predictable depreciation in the back half of the year. That does not mean we're expecting a correction, but the Manheim Index year over year in December is expected to be about 8% up on a year over year basis. So it's an incredible environment for dealer performance, and they are benefiting from improved efficiency as well. So that's a perfect way to hand the presentation over to my colleague, Isabelle Helms.
Thank you, Jonathan. It's a lot more fun to listen to you when you have good news like this, Jonathan.
I agree.
I'll do more of those with you moving forward if you promise to be this optimistic, I promise. What I'd like to do today is really talk about the lasting impacts of all of the changes that impacted our industry, and in particular the consumer and the dealer in 2020. It's no secret that the pandemic created monumental shifts in consumer habits and behaviors. We've all seen the headlines. The way we all shop and buy everyday products, the way we work, the way we eat and entertain ourselves, and my God, the way we are teaching our kids these days. I mean, we've all experienced this radical change that has heightened digital activity across the board, and brands of all kinds have really embraced just this contactless business model almost overnight, creating this culture of convenience. And I'm here to say it's here to stick. So, of course, this shift has had a profound impact on the automotive industry, and that's what we're going to dive into today. So for years, consumers have had this desire to complete more of the car buying process online, removing much of the hassle and the friction of visiting dealerships in person. Here, we take a look at the average number of dealerships that a consumer visits before buying a vehicle. And so as you can clearly see, this downward trend, which started back in 2017, really accelerated as car buyers grew more reluctant to visit dealerships in person as a result of the pandemic. This, by the way, holds true for both new car buyers as well as used car buyers, so across the board. Naturally, what this means for dealers is that there are fewer physical touch points to influence a car shopper, which means that a digital presence has all of a sudden become way, way more important. Since March of last year, nearly 7 in 10 franchise dealers have told us that they added at least one digital step to the shopping process, the most frequent of which included the ability to schedule an at-home test drive or purchase delivery, as well as the ability to apply for credit online. According to our research, buyers are taking full advantage, with 3/4 of dealers reporting higher consumer engagement with digital tools, which of course is streamlining the process for dealers. In fact, the average time that a consumer spends at the dealership has reached an all-time low at 2 hours and 37 minutes, which you could argue is still way too long. But listen, we shaved out 15 minutes off the process, so we consider that a success. As a result, car buyers have never been happier. This chart trends the percentage of car buyers that report being highly satisfied with the shopping experience. Never before have we seen this number break the 70s, never, but it did in 2020. And so when we look at satisfaction across various aspects of the process, and here we're just looking at 7, we saw improvements across the board. But the biggest improvement really centered in the 2 areas where buyers have historically expressed the biggest pain points, denoted here with the little blue box. So how long the process takes, which climbed 10 points compared to 2019, as well as interactions with F&I, which too nearly increased by 10 points. Clearly, moving things online has had a profound impact on the consumer experience, and buyers have no interest in resorting to old ways. I know you've heard this before, but it's clear that digital retailing is here to stay. So as a result of these shifts, I'd like to spend the remainder of our time together today to discuss 4 trends that lenders should really consider as we prepare for an even more digital future. We'll talk about the online application process, what we're calling this new era of direct to indirect lending. We'll talk about digital contracting, and then we'll close things out with at-home vehicle delivery and what we're seeing happening there. So let's hop in. The first trend we'll cover is all about the online application process, certainly a key driver in creating an efficient purchase process for consumers, for dealers, and lenders alike. So as I alluded to earlier, consumer preference for completing steps of the purchase process digitally has really been growing over the last few years. And of course, COVID fueled the fire. So the chart that you're looking at breaks down the shopping process into 4 sections at the bottom and tells us what activities shoppers prefer to complete online or at home. So for instance, if you look at that first bar, looking at the first blue column, you'll see that 63% of shoppers want to find out about specials and incentives online instead of learning about those at the dealership or elsewhere. So what other activities are they interested in? Middle of the page, you'll see that one is the ability for a consumer to receive financing approval online, pretty high bar. Another, the ability to determine a true monthly payment online. And then lastly, I'll point to the ability to apply for credit digitally. All of these are activities that a majority of shoppers tell us they prefer today to complete online. What's also interesting to look at is how these preferences have shifted since 2017. So across the board, you'll see that the desire to complete these activities digitally is up significantly. If you'll just look at the little blue numbers. The biggest jumps that you see here occur across the Make My Deal category, where 4 in 10 shoppers now tell us they want to select F&I products and finalize a vehicle's price online. Another one that I think is interesting and experienced a big jump is the percentage of shoppers who want to sign the paperwork online. That represents roughly a quarter of all shoppers today. So with all of this in mind, I think it's really important for dealers, OEMs, lenders to pay attention to these numbers and prioritize what capabilities you want to provide shoppers. There's plenty of them. Now, when much of the work is completed online, consumers expect a more convenient process overall. In fact, 86% who engage with digital retailing expect to save time at the dealership. Time is the biggest benefit across the board. On this topic, dealers and consumers see eye to eye. And so when we talk to dealers, the #1 benefit that they want to promote to consumers is saving time. The challenge we face is that consumers aren't necessarily leveraging digital retailing tools as much as they tell us they want to. So sometimes that happens because the capabilities simply don't exist and they're not offered by lenders or dealers. Sometimes it simply can be that a consumer just doesn't know they exist. Regardless, significant gaps exist between what they tell us they want to do and what they're actually able to accomplish online. So look at this chart again. This is the same chart I shared just a few minutes ago, but this time we've overlaid the percentage of buyers that actually completed each of these steps digitally. Again, we're basically comparing what shoppers tell us they want to do versus what they actually are able to accomplish online. So if you look at the first column again, 63% of shoppers expressed a desire to find information on incentives online, and nearly all of them, except that 1%, were able to do so. What's interesting to look at are the areas in light blue with the biggest numbers, which represent, of course, the biggest gaps between what a consumer wants to do and what they're able to do. What's clear is that the areas with the biggest gaps all center around financing, specifically the online application process. This is an important finding because we know from our research that the ability to apply for credit online is a key enabler to making the dealership experience more efficient. In fact, buyers who complete their financing application online save nearly 30 minutes at the dealership. More importantly, they shaved off a quarter of time spent signing paperwork and nearly a third of time spent negotiating. So creating efficiencies all over the place. And I'll tell you, for the 10 years that we've been completing this study, the most frustrating parts of the shopping process always comes back to signing paperwork, negotiating the deal, and here we are making significant headway. It's exciting to see how DR is addressing these long-standing consumer pain points associated with making the deal. All right, our second trend shines a bright light on the new era of direct to indirect consumer lending. In this section, we'll discuss how financing is impacted by a consumer's engagement with digital retailing. So to do this, we'll be comparing the behavior of what we're calling heavy digital buyers to light digital buyers. So pretty simply, heavy digital buyers are consumers who complete more than 50% of the purchase process online. And today they represent about 20% of all buyers. We're going to compare them to light digital buyers. Those are consumers who are completing 20% or less of the purchase process online. They represent a whopping 62% majority of all buyers today. So, as one might expect, heavy digital buyers are more likely to research their financing options online rather than depend on the dealership. In fact, 8 in 10 are doing so. In comparison, less than a quarter of light digital buyers are leaning on the internet for their research. So big differences there. Digging a bit more into heavy digital buyers, and if you look specifically at the right-hand side of your chart, you'll notice that they're also significant more likely to turn to the internet to fill out a credit application and also receive an approval notification online, especially when compared to their light digital counterparts. So net-net, lenders who want to be considered by these shoppers need to get in front of them early in the process and perhaps not rely as heavily on their dealership partners for that introduction moving forward. As we see here on this chart, there is a much smaller percentage of heavy digital buyers obtained their loans via dealers when compared to light digital buyers. So here we're comparing the 42% to the 64%. Listen, at Cox Automotive, our position is that the percentage of consumers who classify as heavy digital buyers will grow as digital retailing continues to gain traction. And while none of us can really predict when they will become the majority of shoppers, if we follow the trends, it won't be long. Of course, this presents a huge opportunity for lenders to really rethink when and how to engage shoppers in need of financing. All right, next, we will discuss how true digital retailing is incomplete without digital contracting. Makes a lot of sense. You know, both lenders and dealers are absolutely critical allies in moving the transaction online for the consumer. So I think it's important we spend a few minutes talking about this important trend. Today, over 3/4 of shoppers are open to the idea of buying a car 100% online. Three-quarters of shoppers. Yet, only 1 in 3 franchise dealers tell us they're equipped to do so. And most of the steps that are enabled today online take place during the early phases of the shopping process. So it's things like applying for credit, finding information on rebates and incentives, and so on. But it leaves a lot of the steps on the back end desiring a bit more. You know, the ability for shoppers to select F&I products digitally, the ability to finalize the price of the vehicle and complete the Foursquare, and then let's not forget the ability to sign digitally. Those are big gaps today. Of course, this has given way for new form OEMs as well as online-only digital retailers to come and fill these gaps. We've all heard the Carvana story. Their sales at the end of 2020 was up 550% compared to 2017. They closed out the year with 240 used vehicle sales, slightly eclipsing AutoNation's used car sale. I mean, who would have ever thought? So, and in addition to that, a lot of large dealer groups are also launching their own standalone used retail stores with their own DR capabilities. And so from where we sit, I'll also tell you that it seems everyone is more focused on the consumer than ever before and delivering what the consumer wants. Not really seen that before, but everyone's paying attention and moving pretty quickly. In fact, franchise dealers tell us that they believe that by 2025, 4 in 10 consumers will buy a car entirely online. 4 in 10. If you fast forward 10 years, these same dealers expect that number to climb to nearly 6 in 10 buyers. So clearly, there's no going back. One enabler to bring this reality to life, of course, as we've been talking about it, is digital retailing, and something that we absolutely deem essential to a long-term winning strategy. Today, 3/4 of franchise dealers tell us and acknowledge that they don't believe they'll be able to survive without it. In fact, in the next 2 years, 8 in 10 franchise dealers are committed to bringing even more parts of the purchase process online. And online F&I and the ability to execute contracts digitally seems to top the list as dealers move towards a future where buying a vehicle completely online becomes the new normal. Something else we learned is that dealers who provide remote signatures are more likely to experience a more streamlined and efficient process, significantly more so than those who don't. So ultimately, in this new normal, digital contracting is essential. No DR solution is complete without it. By offering the ability to fully commerce online, clients are not only meeting increasing consumer demands, but they're also becoming more efficient themselves. Any way you look at it, it's really a win-win for everyone. All right, this brings us to our 4th and final point for today, with a focus on how the vehicle delivery process is shifting from in-store to at-home. And so buyer preferences for at-home vehicle delivery has grown significantly over the last 3 years. You'll see here that today, roughly 1 in 4 shoppers would prefer this option over in-store pickup because it saves them time and it's more convenient. And with a growing number of dealers providing at-home test drive, as well as things like 7+ day money-back guarantees, consumers are far less concerned about making a purchase sight unseen. So bring them the car, let them keep it for a few days, and then move forward with the purchase. At the height of the pandemic, most dealers offered at-home delivery services to car buyers at levels we've never seen before. 77% of franchise were offering it, as well as 53% of independents. And by the way, at the time, nearly all of them, 97%, were doing this in-house, leveraging existing staff. So they're pretty nimble. Now, a full year into this pandemic, and what we've learned is that 1/4 of franchise dealers expect to deliver the majority of their purchases to consumers' homes this year, surpassing the typical in-store pickup. So with so many activities shifting from in-store to at-home, fully vetting consumer identities and backgrounds digitally will too become an essential part of the process. You could argue we're already there. And one that I know poses some concerns for you all. So it's definitely something to look into. All right, finally, to close this all out, I have just a few implications to share with you. First, I think it's important we reimagine the online application process to best enhance the lender to consumer connection and really think about ways in which you can engage with car shoppers earlier in the funnel. I think number 2 is pretty straightforward. If you haven't already, it's time to enable digital contracting for your dealer partners. With the majority of consumers seemingly willing and ready to buy a car 100% online, this capability will not stand as a competitive differentiator for long. And then last but not least, think about the implications of at-home purchase deliveries and how you might need to adjust your dealer agreements as this convenience, we believe, is expected to continue to catch on and grow. So with all that, I think we are ready to move into the Q&A portion of our presentation today. Hi, Marcy, I think you're on mute.
Sorry about that. Thank you so much to Isabelle, Jonathan. I'd like to introduce also Andy Mayers and Francis Gochai. They're going to do some Q&A as well. So the first question I like to give to Jonathan, are you concerned about a potential problem later in the year when stimulus support ends?
I'm really not, is the simple answer. In looking at the programs that have been put in place specifically in the American Rescue Plan, we have the enhanced unemployment benefits and the pandemic assistance through September. All of the data about the progress on the vaccinations indicate we will achieve effective herd immunity by the summer. So the job recovery that seems to be picking up rapidly should put the majority of impacted consumers in the shape that they're having wages essentially replace the support, just in time. I think the analogy is it looks like we're landing the plane softly. Are there risks to that? Yes, absolutely. If we have a big interruption in vaccinations, if we can achieve herd immunity, or if there's some outbreak of a variant that basically proves to not be resistant and we go back into more of restrictions and more lockdown, then of course it will then depend on if the government responds and extends support for a longer period of time. But I actually feel much better at this point than I have at any point so far that the support is definitely there the way we need it to be, and it's long enough that will enable us to land the plane, if you will.
Thank you, Jonathan. This is for Isabelle. What type of consumer tends to be a heavy digital buyer?
Oh yes, this 20% of buyer group we talked about today. Good question. They skew more male than they do females. They over-index on being millennials, but there's a huge chunk of them that are also Xers. It's interesting because we don't see Gen Z necessarily gravitating towards that group. They're pretty evenly divided. But we also noticed that groups like Hispanics and Asians are also over-indexing in this category, as do high-income households as well. So just to paint a little bit of a picture about what a high-end digital looks like, they're also more likely to turn to luxury vehicle and inventory in their acquisitions. So they're leading the pack, but we certainly expect others to follow suit in terms of embracing digital tools moving forward for car shopping.
Thank you. Another question for Jonathan. When will inventory and pricing return to normal?
I'm not sure if I have a calendar that's long enough out to be able to give you a good estimate for that, because essentially we're in a very supply constrained environment that isn't going to dramatically change on the new vehicle production side in the foreseeable future. Yes, we have some unique, especially acute challenges right now with computer chips and supply chain issues, and a lot of those will start to become better in the back half of the year and certainly by the fourth quarter of this year. But we're also shifting towards electrification, and even before COVID, we were shifting towards fewer high volume, low margin vehicles to more high margin, low volume vehicles. So we're basically on a trajectory that supply is just not going to grow the way that it did in the past. And we have a very big hole dug by the lack of roughly 3.5 million vehicles that were not produced last year that otherwise would have been. And then in the wholesale market, the supply flows basically suggest that we'll see a little bit of improvement this year and some additional improvement next year, but we're still going to be well off of 2019 volumes feeding the used retail market. And then in 2023, we run into the lagged effect of the substantially lower lease volumes last year that will greatly diminish the off-lease units coming into the used vehicle market. So it's likely 2025 before you see a wholesale market looking anything like what we've become accustomed to over the last several years. So that's very constructive to an inventory environment that's more likely to be constrained maybe not as constrained as it is right now, but definitely constrained relative to normal perspectives. And that means vehicle values likewise will continue to be high. My expectation on vehicle values is that we'll reach the absolute peak in June, and then we'll start to see more normal depreciation or price performance from that point. But it doesn't mean that we're going to have a correction in values, because basically to have a correction, you have to have something major negative in demand for the economy, and that's not in the cards, at least over the next couple of years. And likewise, you'd have to have a major increase in supply, and as I just shared, that's just not going to happen.
Thank you. Another question is for Isabelle. Is there data in the research Cox Auto has done to indicate what percentage of buyers started off with a loan through a bank or credit union and then switched to a different lender through the dealership?
Yes, we took a look at that because, of course, a big question is okay, great, you walk in, you've got your financing secured, and then you flip, right? When we talk to consumers, only 16% or so, I believe, ended up switching loans after visiting the dealership, and usually they do so because of a better offer. So I'd be curious to see what you all think about that number. It seemed a bit low to me, but that's what we're getting for now.
Thank you. And then also for Isabelle, how often does Cox Automotive survey consumers and dealers throughout the year?
Oh, a good question. All the time. We do. We speak with a lot of consumers during an annual period, roughly 150,000 on all sorts of different topics. Of course, digital retailing being a huge one last year, but a lot of different topics. And then same thing with dealers. We talked about roughly 45 to 50,000 dealers on an annual basis. So we always have plenty of great information and insights to share with you all. And please let us know if there are topics that are of interest to you all, for sure.
Thank you. And this one's for Andy. Can you provide any opinion to the direct lender versus indirect lending trends?
Sure. I think there's a couple things that are driving that. Consumers are much more concerned, as Isabella laid out, in trying to get financing up front. So they are looking to save time, and they're going to their traditional methods of their existing banking relationships. They're using tools online, like through an Auto Trader. They'll go to a website and they'll see a lender they do business with. But also lenders are trying to capture and retain their existing customers. There's been a big push from our lenders as well to retain customers. I use this example. I'm a Chase customer just to see today. I get an email that says, if you're interested in getting financing a vehicle, I can get that done for you. So we're seeing kind of the trinity where the consumer and the lender are still pushing to get the financing. But what we're still really seeing, and kind of in response to Isabelle's question a minute ago, it's really more of a direct to indirect model, because a lot of our lending partners are still taking those direct originated loans and handing them off to their dealer partners for financing. And I think that's what we're seeing the most of. And it's been a great way to establish a partnership between the dealer and the lender, as the lenders are providing value-added service to their dealers by giving them a pre-approved customer. And we do have some ways to go to keep those pre-approved customers from not being flipped. The lenders have a relationship that they need to continue to harvest with their dealers. But I think that's what you're really seeing, is the confluence of direct lending from the traditional banks and financing sources that want to retain customers, consumers looking for a financing up front, but ultimately still contracting through the dealership. And that's how the direct to indirect model is kind of seeing a lot of that space now.
Great, thank you, Andy. This question's for Francis. What are the consumers comfortable with in terms of time when going through the application process online? Do you start losing someone at the 2-hour mark, for example?
Yeah, so I think, during Isabelle's feedback, she kind of talked about what the consumer was experiencing online and different statistics around, what was important to them. Not every single online application is the same. Not every digital retailing experience is the same for various consumers. So it really depends on what that consumer is looking for. I'd say, does that experience that the consumer's in, is it allowing just the ability to submit a lead? A lot of customers are doing that today, and then the dealership works the deal from there, and there's no callback. I think Isabelle mentioned here during her feedback that 58% of consumers were looking for financing online. It depends whether or not they're going to get that information. So, a 2-hour mark, for example, I don't foresee a consumer going through an application and spending that much time online. I think the time where they're looking at 2 hours plus is when they're in store. But ultimately, I think as post-COVID and digital retailing becomes more prevalent in the space, I think having a uniformed experience from being able to submit a lead, full credit app, and having the proper details involved in that credit app, submitting to a lender, having that lender provide the callback so the consumer can see it, is what is going to help create the transparency a consumer needs to complete a deal online and not fall off. So I think every experience is a little bit different, but I think you're going to start to see more alignment in the near future.
Great, thank you, Francis. This one's for Jonathan. I've heard that one of the reasons that subprime auto lending was down because of credit scores were up. So there are just fewer subprime borrowers. Are you seeing that?
So indeed, average credit scores have improved, and especially so over the last year because of the situation that consumers have been in with more money to pay down debts. But the latest credit distribution data definitely show that subprime numbers in the population have declined. So yes, I do agree that contributed to some of the decline in 2020, but it doesn't explain the severity of the decline, meaning the decline in originations was far bigger than the decline in the population. Part of the decline could have been caused by the disproportionate impact felt by especially lower wages, more likely to be subprime, by the pandemic itself impacting those jobs in those sectors more. And what I mentioned, that we had really inconsistent fiscal support throughout last year. But I also think the simple calculus of the record prices that we have and the not very attractive rates certainly last year contributed. So what I see in the data in March is actually more consistent with subprime being properly represented compared to where they weren't being properly represented last year. And I think a lot of that has to do with the finance calculus.
Thank you, Jonathan. This question is going to be for Andy. Digital signing at home, does that initiate a cooling off rule?
So I always have to answer this question first by saying I cannot give legal advice to anybody, but what I can tell you is that the interpretations that we've heard and what's been communicated to us and best practices we share is that as long as you don't negotiate the terms of the agreement with the consumer at their home, and you only actually deliver the vehicle and execute the paperwork, you do not initiate a cooling off or rescission period. So the best practices that we inform our dealers are to ensure that in the digital retailing experience, in-home deliveries, that you make sure you have the deal negotiated. Prior to, you do not renegotiate on site. We also, from a best practices perspective, provide our dealers some guidance on additional documentation that they want to sign and have the consumer sign to do a proof of delivery, to make sure that when they deliver the vehicle that they have confirmed the customer's identity, and also that they have reinforced that the customer's gotten a copy of their installment contract and all the necessary paperwork. So it does not necessarily initiate a cooling off period as long as you don't renegotiate the terms.
Thank you, Andy. This question is for Jonathan. With the supply chain issues with the semiconductors, did that factor into your end of the year SAAR?
Yeah, I would say we have been very conservative to begin with what we were expecting production to be able to do this year, initially just simply because of COVID. But then the computer chips, then the winter weather producing plastics, foam, and now rubber challenges. It's just been a perfect storm. So absolutely, the number that we have right now is consistent with what the best production forecasters and what the OEMs are saying. I can tell you that it seems to me that the news is a little bit more significant than what we're observing with the sales, because we had a total SAR of new vehicles in March of 17.7 million. And it seems like with all of these challenges, how is that possible? And part of the answer is the manufacturers have done an outstanding job of managing their inventory and managing the semiconductors specifically, because they're fairly fungible across vehicles. And so essentially they've moved those chips where they're most in demand in terms of the lowest inventory vehicles and the fastest selling. So they've kind of managed within their supply chains. Can they keep this up throughout this quarter? If we continue to see such strong sales, it's probably going to be more challenging. But so far, that's why you can have record sales, and particularly retail sales. By the way, fleet's not coming back because the OEMs are prioritizing retail, and perhaps that's part of the answer of why it hasn't been as acute as it otherwise would seem to be.
Thank you. And this question's for Isabelle. When purchasing a vehicle completely via a digital channel, what methods do customers have to validate vehicle value or history outside a Carfax report?
Okay, well then I have to give a pitch for Kelley Blue Book, right? That is still the #1 destination for determining a vehicle valuation for a consumer. I'm not sure about alternatives to Carfax. If there are some on this panel that know of alternatives, let me know. But the other thing that comes to mind to me is dealers are becoming a lot more flexible, understanding that consumers are desiring to purchase vehicles outside of visiting the dealership. And so we're seeing a lot more dealers just leaving the car with the consumer for 24 hours to experience a real test drive. I'm sure you all probably saw this past week, CarMax is doing that for 24 hours, and they've partnered up with Dunkin' Donuts, so you can go through a Dunkin' drive-through, like a real test drive where you get your coffee and see if it fits in the cup holder. But then they're also extending these providing these guarantees as well. I think that buyer's remorse is still the biggest concern that a consumer might have, especially when purchasing a car sight unseen. And so dealers are being increasingly more flexible.
Yeah, and Isabelle, I would also say that not too different. The car buying experience, digital retailing experience, the trade-in process is still something that is a growing process. In other words, a lot of different ways that our customers are selling cars back to dealers online, but there are trade-in evaluations, not too much different from what happens today. You're gonna give a price back to the consumer as a dealer, tell them what you're willing to pay for that vehicle. So there is communication between the dealer and the consumer when the consumer is doing the trade-in process. We're obviously putting the hands and the responsibility of the walk around into the consumer right now. So it's more verification processes that happen afterwards as well. So the tools are always improving for people to take pictures and upload information for dealers to give vehicle valuations back to help finance the deal. And that's a growing part of our industry.
Great, thank you. Looks like we have time for 2 more questions, and these will be to Jonathan. The first one is there any word on the manufacturers and inventory?
Was sort of related to the chips before. The word is that inventory is definitely going to be tight. I think their willingness to tell you how quickly they're shutting down production and things like that is an indication that they're managing expectations on the part of dealers and consumers to expect a very tight supply environment. Their indications are that new vehicle inventories will improve more in the back half of the year, and especially probably in the fourth quarter and starting into next year. We think the 22 model years are going to be behind in a typical rollout, but once we start to see fewer of these announcements about factories being shut down, which we think will be occurring probably in the summer, then we'll start to see those inventory levels improving. But as I shared before, it's not going to be quote unquote back to normal levels or what we had, say, even in 2019 for the foreseeable future, because if sales are strong, you essentially can't build up inventory. And we're not going to have an overshoot of production that lets you build inventory back up. And so it's another reason why I think the supply levels will continue to be relatively tight, just not as tight as we're experiencing right now.
Thank you. And the last question is, will Manheim eventually correct to pre-COVID levels? If so, when?
I'll have to assume that means the Manheim Index correcting back to pre-COVID levels. And it's a great question. The answer is we don't have in our forecast horizon, and right now we're going out through 2023, any type of correction. We do expect normalization of performance starting this summer, and really we believe the dynamics are going to reflect more quote unquote balance between supply and demand going forward. But there's nothing that would cause you to expect values to strongly correct, because when values drop on the Manheim Index, it's usually driven by an extreme supply overbalance relative to demand, and that's basically not in the cards. So what ends up happening is we have depreciation patterns starting to return to normal in the second half of this year. We end the year with the Manheim Index up about 8%. Next year, we just don't see the increases we're seeing next year, next year, because we're in more of a balance. And so normal depreciation patterns mean that, at least in terms of a year-over-year performance, we actually have some negative months in 22, but it ends up being a relatively normal year. So we're not projecting any more abnormal weeks of price increases like we experienced last year and again this year, but we're also not forecasting a quote unquote correction.
Great, thank you so much. Thank you to Cox Automotive, Isabelle, Jonathan, Andy, and Francis for the Q&A and the great webinar. The recording and slides will be available on ASPA's website in the Webinar Resource Center. If you want to make any concluding remarks, feel free to.
I've definitely said enough.
Well, thank you, and hope you guys have a great day.
Thank you.
Thank you.